Hello everyone. So today I'm going to discuss about investments in held for trading debt securities. This topic is common for both IFRS and US GAAP. So there is no differences between the both of them. So let's look at the topic that I'm going to discuss for today, that is accounting for investment in debt securities. Under that, held for trading debt securities. Now, accounting for investment in debt securities, the investor generally classifies the investment in debt securities in three categories: held for trading debt security, available for sale debt security, and held to maturity debt security. Now, this choice, or what the investor decides, is the sole decision of the investor, and this depends on the intention of the investor on the date of purchase of these securities. So date of purchase is very important, and what is the intention of the investor regarding such securities, they will be classified accordingly. Now we as an auditors, we cannot question the investor or investing company on why they have chosen a classification. That is the sole right of the investing company. Now, what is a held for trading debt security? This is generally a security that has been purchased with the intention of selling within a short period of time, generally less than 1 year. So investor has generally purchased this security to sell it within 1 year. So what should be the purpose of the investor? He is generally expecting to make some profit by trading this security. So if the value of the security goes up in the market, he will sell it at a higher price than what he purchased for, and he will make a profit. So that is the basic intention of the investor on purchasing these securities. The only motive is to sell them within a very short span of time and make a profit. Now, accounting for held for trading debt securities is generally done using FVTPL method, or fair value through profit and loss method. These investments are reported at fair value, that is market value, on the balance sheet at the date of the reporting. So using the FVTL method, these assets, securities will generally be reported at fair value on each balance sheet date. How do we get the fair value? Since most of these securities are trading in the market, we can simply take the closing day price or the average price on the date of the balance sheet for these securities to arrive at the fair value. And any unrealized gains or losses on this security on the balance sheet date will be reported under income statement. So there are two aspects. For the asset, that is the debt security, the asset will be reported at fair value, and any changes in the value of the asset, that is from the cost of purchase and the fair value on the balance sheet date, that will be reported as part of income from continuing operations on your income statement. Why these are unrealized gains and losses? Because they have not yet been sold as on the balance sheet date. Had they been sold, they would have been part of your realized gains and losses. But even unrealized gains and losses for such securities will be reported under income from continuing operations. Now, these securities are generally reported under current assets since the intention is to sell them within 12 months, that is 1 year. Now, what is a journal entry? Because as I keep on telling, accountancy is all about understanding journal entries. So, what is the journal entry for recording an appreciation or increase in the value of held for trading debt security? So, on the balance sheet date, if the value of investment in debt security has increased, therefore the asset should be debited. So it will be investment in held for trading debt security debit, and the credit will go to income statement. So it will be income from trading security credit, and this will be part of your income from continuing operations. So the debit will generally increase the value of the asset on the balance sheet, and the credit will be part of the unrealized gains and losses and will be reported on your income statement. What is the journal entry for recording a decrease in the value of held for trading debt security? Very simple, just the reverse. Since the asset's value has declined from the date of purchase, so the asset is credited. Generally, the rule is if the asset value increases, it's debited, and if the value of an asset has decreased, it is generally credited. So investment in debt security will be credited, and this will reduce the value of your investment in the balance sheet. And there will be a corresponding loss, unrealized loss from trading security, that will be debited and will be reported as a loss and part of your continuing operations. Now, let's take an example to understand this very properly, that how the journal entries are passed and how they are reported on the balance sheet. ABC Limited purchased a debt security on 30th June 2022 with the intent of selling it within a year. So ABC Limited has purchased a debt security on 30th of June 2022, and the intention of the investing company is to sell it within a year. Therefore, it classifies as a held for trading debt security. The cost of the purchase of the security was 100. And on 31st December 2022, the security was still not sold, and the market value of security on the balance sheet date, that is 31st December 2022. Situation 1, which I am going to solve, 120, and situation 2, $80. You should solve it for yourself to check your understanding. And then on 1st of April 2023, ABC Limited sold this security for $140 past journal entries. So first of all, let's summarize the questions. ABC Limited has purchased a debt security on 30th of June. The security has been classified as held for trading. The cost of acquisition of the security was $100. On balance sheet date, the security was still not sold, and the price or the market price of the security was $120. And on 1st of April 2023, ultimately the security was sold for $140. Now, there are two financial years involved here, 2022 and 2023. Let's look at the journal entry. So first situation that I am going to solve, if the fair value of the debt security was $120 on the balance sheet date, that is on 31st of December 2022. Now, let's pass the journal entries in a sequence and understand their impact on the balance sheet and income statements. On the date of purchase, the investment in HFT debt security is debited for the cost of acquisition, that is $100, and cash has been credited for $100. On the balance sheet date, this debt security has to be marked to market. Now, what is marked to market? This means this has to be brought down to its fair value on the balance sheet date. On the balance sheet date, the fair value of the security was $120, and the cost of purchase of the security was $100. So the value of the security has to be increased by $20. And there is an unrealized gain that will be reflected in the income statement. So the value of the asset has to be increased. So debit the asset. Investment in held for trading debt security, debit $20. This will increase the value of the asset on the balance sheet, as I have pointed out. The debit entry has an impact on the balance sheet, and credit will go to the unrealized gains in the income statement. So income from trading security will be credited by $20, and this will be part of your income from continuing operations. Now, what has actually happened in balance sheet? The security will be reported at fair value or market value on the date of the balance sheet, that is $120. In income statement, an unrealized gain of $20 will be reported as part of income from continuing operations. Where did this $20 come from? The difference between the fair value of the security on the balance sheet date and the cost of purchase. Since the fair value of security has increased, so there is a gain. Now, for the next year, that is 2023, the new valuation basis of this security is $120. Just forget that you purchased it for $100. Since you have already increased this in balance sheet to $120, and you have also recorded a profit of $20. So now the new cost basis of this security, we can simply say, is $120. On 1st of April 2023, the date of sale on the security, or the date on which the security was sold, it was sold for $140. So cash debit, what comes in cash was debited for $140. And this investment in trading security will go out. But as I told you, the new basis for investment is the balance sheet date value, that is in this case $120. So investment in HFT debt security will be credited by the new basis of valuation, that is $120, and a further gain will be reported on the income statement as part of income from continuing operations. So 3 entries were passed here. On the date of purchase, the security was purchased for $100. So investment to cash, $100. On balance sheet date, the security was still not sold. So since there was an appreciation in the value of the security by $20, we increased the value of the investment and made it $120, and credited an unrealized gain in the income statement, directly to the income statement, your profit and loss account, by $20. Now this new $120 became the new cost basis or new valuation point of this security. So finally on 1st of April, the security was sold for $140. Cash came in by $140, and the security that went out was valued at the new basis, that is $120, and a further $20 gain was reported on the income statement. So what actually happened in the entire transaction? Summary I have created. The total profit credited in income statement is $40. $20 was credited in 2022, that is on the balance sheet date, when the value of the security increased. $20 was credited in 2023 on the date of the sale, because the sale value $140 was more than the balance sheet date value, $120. So further $20 of gain was credited in 2023. Now, what was the original purchase price of the security? $100. And what was the final sale value of the security? $140. Difference between the sale price and the purchase price, $40. And this is the value of the gain that has been credited to the income statement. So you should always remember that in this accounting, the gain may be reported in different financial years. Like in my example, $20 was reported in 2022 and $20 gain was reported in 2023. But the total gain reported would always be the difference between the purchase price and the sale value, because that is the actual gain or loss that you are going to have on the security. So this is it from my side on investment in held for trading debt securities. And I would request you to solve the second example, which I have not solved. What if the balance sheet value was $80, and see if you are able to pass through the journal entries and you get the correct answer. So thank you from my side. Hope this video was helpful for you. Thank you.